Good morning and welcome to today's webinar. I'm Jen Pui, Vice President, Operations and Member Services for IIAB Cal. Today's attendees with a California insurance license can receive 1 CE credit for this webinar. There will be poll questions that will appear throughout the webinar, and you must answer all of the poll questions to receive the CE credit. We are recording today's webinar and have muted your microphones to eliminate background noises. As a note for those watching this as a recording, CE is only available for those attending the live webinar. The recorded version is not eligible for CE per California regulations. For those watching this live, you can ask questions throughout the session by clicking on the questions icon in the toolbar located at the top right-hand corner of your screen. We are excited to have Carey Wallace with us today to discuss state of insurance in the M&A marketplace. Carey is the founder of AgencyFocus, a consulting firm focused on providing valuation, perpetuation, financial, and planning services to independent insurance agents across the country. She is also the co-host of the Insurance Refocused podcast and a frequent industry speaker. IIAB Cal members now have special access to Carey's services and firm, including a free 30-minute consultation in addition to free members-only webinars such as this. She may be contacted by email at carey@agency-focus.com or at agency-focus.com. Thank you, Carey.
Of course. Thank you so much for having me. I'm excited to be here. So I am excited to jump into what's happening in this insurance marketplace. How is it impacting the M&A space, and how are agents responding to marketplace changes? So let's jump in. I've actually provided a couple different perspectives of what's happening inside the independent insurance agency system and a couple different sources. And the first one is the Agency Universe study. So for those of you that don't know or may not read this kind of study, it comes out every 2 years. It's by Big I National. And the 2024 Agency Universe study has some highlights of what's happening inside our industry. First thing is the number of independent insurance agencies across the country 2 years ago was 40,000 independent insurance agency owners. Or independent agencies. That number has slightly decreased to 39,000. I've been in the industry for about, I think it's 17 years now. When I first started, it was hovering around 36,500 independent insurance agencies. So it has climbed. It is slightly decreased from the last 2 years, but the climb was a result of many agencies moving from captive to independent. It also is a result of M&A, believe it or not, where agencies are bought. There are producers that then maybe peel off and start their own agencies. So it's changed the complexion of independent insurance agencies by size, making the smaller agent much more prevalent than the larger agency. And in the middle, the number of agency owners has actually declined. But overall, this number has slightly declined from 2022 to 2024, mostly driven by M&A and succession and perpetuation challenges. 1 out of 3 independent insurance agencies expects to have an ownership change within the next 5 years. That's roughly 12,000 independent insurance agencies are thinking about their perpetuation. There's been strong revenue growth where 75% of agencies reported revenue growth between 2022, 2023. That's up from 62% in the last report. So some of that is being driven by rate, and most of it is actually revenue growth in general. That growth has been 60% in personal lines and 68% in commercial lines, which is up from 57%. So super great to see the health of the independent insurance agency is strong and alive and well. The hard market is definitely driving agencies to become more efficient. 63% emphasize a need for operational efficiency during this time. 56 are focused on preparing messaging around the market conditions, and over 25% have actually changed how their digital and interactive workflows are in order to respond to the changes due to the marketplace changes, all the rewrites or remarkets that were as a result of having a hard market. I will also say in some markets, they're seeing rates stabilizing and declining, which means we're in this between state where some it's still difficult to find markets, some it's actually opening up, which are causing even more requests from carrier or from customers to be able to remarket and think that they might be able to get a better deal. So there is this in between. It depends the market you're in. I know you all are in California where market conditions are still heavy, heavy, heavy on your mind. No question about that. As a result, there's a lot of agencies that are thinking about technology and technology adoption. That technology surge, there are so many resources out there, and there's consolidation in the technology that's out in the industry, making it some challenges between both the confusion of who to go to, the cost, the consolidation, and creating some kind of challenges to know how to navigate those decisions. So there are organizations out there designed to help agencies navigate those technology decisions, like Catalyst, which is an organization that's founded by state associations, a group of state associations, and really focused on helping agencies make that decision. Cybersecurity is 100% on the minds of many agencies. It's a core vulnerability for small businesses across the board. It's also one of the most rising, insurance coverages that are being offered, but also on the minds of agencies to make sure that their cybersecurity is super sound and their systems are in place. And there's definitely still an ongoing concern about emerging purchase channels, especially in personal lines. So those are the key marketplace trends that the Agency Universe study highlights. I will say from every different organization that does surveys surrounding independent insurance agencies and what those trends are, consumers' expectations are on the minds of many agency owners, and just the knowledge that our consumers have different expectations than they did before, and those expectations are changing significantly as the marketplace is changing. So things like the generation of who is buying insurance has changed. There's now 4 generations in the workforce. We've got actually there's 5, but the 5th is emerging out. But baby boomers are about 27%. Then you have Generation X also around 27%. Millennials have about 40%. But the reality is 75% of our population can't remember a time or have only known a time where we've had Google, where we've had access to data in a very, very efficient way. And the generation after me doesn't remember a time that they didn't have access to cell phones and immediacy around us. So that's impacting all businesses, not just insurance. But that is true that the millennial, Generation Z, and Generation A are born, those people never knew life before Google, which is crazy. It makes me feel a little old, but it is the reality, and that's who we're serving. There is this huge change when it comes to people inside independent insurance agencies. They're calling it the silver tsunami, where, as the Agency Universe study highlighted, there's a fair number of independent insurance agency owners that are contemplating whether this might be the time to start thinking about retirement, transition of ownership, possibly external sale or internal sale. The average owner age is 56 at this point, with about 21% over the age of 66, beyond retirement age. The average age of a producer is 54, and the average age of a service or CSR is around 52. So talent is on the minds of lots of independent insurance agency owners. And I will tell you, from my perspective, where I deal with a lot of agencies that want valuations or are thinking about perpetuation, or thinking about selling, one of the main reasons over the last 2 years was not the hard market. It was actually staffing changes that caused an agency owner to think this might be the right time for me to transition, because overcoming talent challenges given the great resignation, and then the great, people thinking about remote work, thinking about movement in the employment environment, has caused stress, especially given the compounded with the hard market and with the changes in the customer expectation. Those three forces on our industry has caused lots of people who have been or at or near retirement to think this might be the time. You add this whole technology surge, which seems like a big mountain to climb, especially given lack of people, lack of more work, lack of people, big change with technology, and an aging workforce that has created maybe that this might be the time. So people in the line of work of me, where we do valuation work or we do M&A, the buying of agencies are actually at an all-time high. Maybe not with announced deals, but with smaller deals. Those people that were waiting and thinking, I'm not sure that this is the right time, there's a lot, and really that staffing challenge is what pushed people over that edge. So talent, keeping and retaining key talent, has become one of the largest concerns inside an independent insurance agency owner. It's not a new concern, but even those hard market pressures, that while that's the number one, you'll see it, the same study asked, what is the number one concern for you? And while they listed the hard market as their number one, I think 56% said that. Keeping and retaining great talent was somewhere around 46%, and then specifically producers was 33%. So it's still heavy on the minds. This is a headline that was put out in the insurance news, where they said that insurance sector was to lose around 400 workers by 2026. And this has been a statistic that has then specifically increased because of the changes in our industry. It's interesting, though, given what's happening in our environment with AI, with technology. I will also say some of these roles, traditional roles inside an agency, are shifting to maybe automation, parts of the role being automated, parts of the role being utilized VAs, parts of the role potentially using bots, where this movement isn't a one for one. It might mean we expect our staff to be more efficient with this technology help, or with the use of VAs, or with the use of rethinking how this staffing is. But that's not true for every role within the insurance agency. So before I get to those specific roles, I'm going to let you launch the first poll question so we can move these out. I'll give you a couple minutes to answer this, or a couple little bit time to answer the question. Fantastic. I know you can't see my screen, so I'm going to wait until that poll is gone in order to show you the next statistic about the specific roles inside the agency. All right. Love it. All right. So while we think that there's some workers that are going to transition, this is what's super interesting. Again, in this agency universe study, it said 67% of agencies are looking to expand their headcount. And then I went to Gallup and said, what is the staffing forecast for independent insurance agents? And it said producer roles are expected to grow by 6 to 7% over the next 5 years. But account managers and CSRs, there's mixed stability, with technology and digital tools increasing the efficiency expectations in these particular roles, will actually increase, reducing the need for the number. So as we have retirements happening and this surge of technology, this number actually might remain flat, even though we have this change of staffing happening across the industry. So it's interesting to see what will actually happen, but that is what the Gallup statistics said about what the complexion is. While overall, producer needs isn't going to change because that's really a sales role that can't be automated. While there could be parts of that role, the administrative parts of that role could change. Really, those roles are continuing to grow. Account managers, it's unclear if it will grow the same amount or flatten. And then 40% of owners will be seeking succession and ownership transition within the next 5 to 10 years. So those are the statistics that said what's going to happen in the workforce. This is the trend by generation of what the current makeup of the workforce looks like inside an independent insurance agency. So this is where 27% are baby boomers, 27% are Gen X, 44% are millennials, and Gen Z, you can see, is really on the rise over the last 5 years, but they're still only making up somewhere between 1 and 4%. I know that the number looks a little different, but these are, I think, overall what happens in Gen Z, but the one on the left is actually, or one on the right is actually what looks like inside an independent insurance agency owner. So you can see baby boomers are on the decline. Millennials are the majority still, and it's still on the rise. What's crazy interesting is what generation holds the percentage of the roles inside an independent insurance agency. So you can see boomers make up 85% of executive leadership, agency principals, mid-level management. They make up only a fourth of that. And producers, it's only a fourth, where Gen X has taken over in the mid-level management and producers, and millennials actually dominate the account managers and CSRs. So from a generational health standpoint, you can see different roles have different risk factors when it comes to who currently owns those positions. This is as the industry overall. Your own agency might look very differently, and I have a lot of agencies that their generational health might look like everybody is getting close to retirement age, or a segment of their agency where the producer and the account managers that work on a specific niche inside their agency might be both at a retirement age, creating some risk that knowledge is going to leave. Those relationships might not be as strong. And so when we do evaluation, one of the things we assess is the generational health specifically inside the agency. But as an industry, the risk is really among the top level, and how we're going to fill those top level roles in the executive leadership and agency principals if we aren't feeding the younger generations through that process. So it's a super interesting dynamic, and I will tell you, at least 45% of the agencies that come to me are interested in internal perpetuation. Whether or not financially they can make that happen, or whether or not they can find the right candidates internally that are willing to take on that debt, is a whole nother talk show. But this is putting pressure on the ability to transition internally, because there's such a need and such a large number of agencies that are facing this. The flip side is, if you're coming into this industry or you have some experience as a millennial, there should be great opportunity to find a pathway to ownership, and what an incredible opportunity that is. So I feel like it's still the best kept secret, sadly, and it shouldn't be. It should be something that we should be, as an industry, talking about, because there's such an opportunity. So many agencies are redesigning their team because of all the reasons that I've told you. And in the M&A space, the people are still one of the most valuable assets inside an agency. They're also the largest expense inside an agency. So the agencies that are really being thoughtful about what roles do I have, how can I create capacity, manage still growth but get profitability are the ones that are really thriving. So what are some ways that they're redesigning the team? They're leveraging virtual assistants, outsourcing some kind of the work. They might be leveraging technology or automation and AI. I do an entire talk on just that and the impact that it has on the agency, and also not just the value of an agency, but the risk inside an agency. But here's the reality when we talk about technology, AI, and automation. This is a chart that was shared by someone who was leading ACT, and I never knew this until I thought this visual put a great picture in mind of how quickly our um, society is adopting to new things. So this is basically saying how long did it take for 100 million users worldwide to adopt each of these tools. So LinkedIn was introduced long ago. I don't even know when it was introduced, but basically when that time frame, it took 7 years and 11 months to get 100 million users on LinkedIn. ChatGPT, while it's not a new thing, AI is not actually that new, but ChatGPT was something new that took it to everyone. It took 2 months to get 100 million users on ChatGPT. TikTok took 9 months. Facebook took 4 years. So we are clearly adopting new technology faster and faster and faster. And I think that first slide where I said, the number of people that never ever knew life before the Google life, that is what's causing this adoption to get faster and faster. But there's plenty of boomers that absolutely are adopting because that's the environment we're in. And if you're not there, you're not able to keep up with the times. Here's the other crazy thing. This was shared by a Hartford economist, and it basically said when there's innovation, then it becomes the norm. And that becomes what the standard set of the norm is. So it talks about in each of these times that technology that came after the Industrial Revolution, it then became the norm. And then there are other things that happened at the Great Depression, et cetera. Well, the internet did that, we all know. I think COVID did the whole video conference and how we communicate with each other and how remote work now became the new norm. This is put here to demonstrate if you're not adapting to technology and how to do business and you're 2 or 3 steps behind, it's really difficult to be as efficient as those agents or those businesses or those people that are keeping up with the times, because that new norm and the expectation is moving forward as these things are being adopted. So, for many agencies, again, they're thinking this might be my time because I'm not willing to go through what's needed in order to adopt the change, but yet everything around me is adopting it. And I'm now competing against agents that are adopting it, are able to get leads in a different way. Their staff is working in a different way. They're able to be more efficient and not do things the way we've always done it. My daughter joined our organization, and we were talking about the fact that she's never ever had a commute to work. She's only ever known remote work. And say the same thing, she's 26 years old. Her colleagues that graduated at the same time, there's only 2 of them that know what that whole commute and management is to your day. They all have gotten remote work because they all started work during COVID, got jobs that were during COVID, and they've never been pulled back into an office. So there's this whole segment of the workforce that really don't have the same perspective of those of us that have had 30 years in the workforce. AI-driven training on coverage knowledge is definitely a surge. This is an example. There's plenty of examples out there where there's an AI, the intelligent agent, that is a closed AI, where your agency can access information on coverage and actually help train new people that are new to the industry, and also standardize the knowledge that you might have inside your agency very, very rapidly for those that maybe don't have the same knowledge to have access to a knowledge, or compare different coverage documents. So the technology is moving very, very quickly. And again, it's going to create this gap between agents that are able to adapt to this and able to utilize these tools and the ones that are not able to, and changes those people that have had 30 years in the industry and those that are looking at what's going to happen for the next 30 years. But that rate of adoption is shortening the time frame, and it's changing what the expectations are around what agents need to do to stay up with the change. So one is using AI. Others, there's people that are using bots in order to automate different parts of their workflow that are very repetitious. How do I deal with canceled non-renews inside my agency? If I do the same thing every single time, can I automate what that messaging is rather than have a human being reach out? Can I then change my retention rate because I might be able to save some of those and get them back? That's the, first thing is we might use a lower cost employee in order to do it. The second is, could I automate it and actually create capacity on my team for some of these different administrative ways? You can see how that might change what's happening inside an agency. So all of this to say, there's a lot of pressure, and insurance has been historically slow to evolve. And the reason for that is, what makes insurance so unique is that retention that we have, that renewable income that stays in the high 89 to 92% historically before hard market. And we are in the high 90s in the middle of the hard market for revenue retention. That has caused us not to have the pain to adjust. The question is, will these expectations of our customers and the adoption of this information or this new way of doing business create a big gap and change the value of the agencies that aren't adopting versus the value of the agencies that are, because they're able to command higher growth rates, higher profitability, higher different ways of attracting business to them that agencies that are operating in a traditional way will not be able to compete with. So I think this evolution, while we've been slow, it's still, the world around us is changing and causing us to be able to, really need to do this. I believe that the agencies that marry relationships, technology, and data are the ones that are going to thrive, and those that are not able to do that will struggle to compete over time. But again, you're going to see these changes in other industries occurring much faster, simply because of who we are, and that renewable income will cause you to continue to be valuable. So how are agents responding to all these things? I think we covered this a little bit, but agents are definitely rethinking their teams and workload, and some of that's out of necessity. Like, there is a shortage of qualified employees. So in order to keep up with the growth, they got to think about doing things differently, and how can we create that capacity? They're definitely implementing retention strategies in this hard market that they didn't have before. They're thinking about their infrastructure and their policies and procedures in order to make sure that a focus on retention is important. Many agencies have really contemplated developing a niche that also allows them to become much more focused and much more profitable. I'm not saying you can't be profitable without a niche, but you've seen a surge in agencies that have a niche-based approach to where they're focusing. About 56% of independent insurance agencies have a well-defined niche. That's certainly up from where it was a couple years ago. They're exploring technology without question. They're looking for ways to create capacity and increase efficiency. They're investing in automation. They're redefining what their expectation and goals are for some of their staff, and they're looking on whether or not they need to join a network. I will say this environment has put a lot of pressure on the networks as well. So it's not as easy to find a network that's looking for agents, but the need has been created with those carrier changes and lack of carrier access during this hard market. So I'm going to definitely pause so we can do our second poll number or poll question here. And I'll give you a couple times to think about the question that you're being asked. One of the things that are on here on how agents are responding, I would say some agents aren't responding and they might be transitioning. They might saying, hey, I think this is time for either my next generation to tackle this. I think it might be time for me to exit and potentially sell. Like that is one of the responses that is being elicited, and asking themselves, is this my high? Like, the way that I am running my agency, is this my high? And if it is, what's happening in the M&A space? So lots of agents come to me. We do about 250 valuations a year for agencies of all sizes in order to do just a health check on an agency to say, what is my range of value and what should I expect my agency to be worth in this current environment with my current risk factors and my current makeup. It's a great way to say, hey, if I'm looking to exit, or I think that I'm nearing retirement and I don't have an internal, what could I do to maximize my value? And what could I do to best position myself? Because let's face it, your agency is an incredibly valuable asset. For some, it's their most valuable asset. But for many, many agencies, it's definitely in their top 5 of their most valuable assets. And then wherever you are in your life cycle, there's great value in the agency. Maximizing it and being aware of what commands that value is really important. So I'm going to definitely talk to you about what's happening in the independent M&A marketplace. It has been growing steadily without question. Over the last 15 years, multiples have almost doubled in the last 15 years, and that's largely driven by the insurgence of private equity money that loves that retention and that makeup inside an agency. So oftentimes I'll get asked, do you think that multiples are dropping, or when do you think multiples are dropping, and how much more could these multiples continue to grow? And my answer to that question is, the nature of an independent insurance agency has to change for the multiples to significantly change. But I will also say, not all agencies are created equal. Not all agencies can command the same multiples because of their makeup, because of their risk, because of their predictability. So while multiples are staying solid, what each kind of agency can command definitely has been changing. So 2024 was one of the most active years with 847 reported U.S. transaction. I think it's the third highest year of reported transactions. Keep in mind, many transactions are not reported. So many sales, especially internal sales or agency to agency, are not reported, especially if there's an owner financed note. There's no bank record of it. There's no whatever. These are actually reported publicly. These are reports that there's been some way that they've been reported. Either there's a broker involved, etc. So this is on the higher end of the transactions that are happening. The highest number was in 2022, and what drove that number to be the highest was at the end of that year, there was a thought that capital gains taxes were going to change significantly. So anyone that was close to or near retirement age rushed to get their deal done by the end of the year because they didn't want to face that capital gains change. Anytime there's something like that happens in the marketplace, you'll see a surge. But otherwise, it's actually remained pretty constant since that time because of the aging demographic and, again, all these forces that we're talking about. The Q1 in 2025 actually started slow, but buyers are still eager to deal, and the deal volume is expected to rise. Private equity backed buyers dominate by up to 78 to 80% of the deals. Again, these are the announced deals. And if you're not backed by capital, you're competing with those who are. So it's aggressive. I will say the increase in interest rates caused the number of buyers to be less, but there's still far more buyers than there are sellers. So there's great demand inside the industry. It's just that now the due diligence and the requirement of information in order to close a deal and command multiples that are commensurate with what the marketplace is became greater. So if your financials are dirty or you don't have good data, you're never going to command what the other agents are that are able to provide that data and provide that confidence in the predictability of the ongoing performance of your agency. So it's so very important to have solid financials, know what your value is, and be prepared as you move into that space, because money is more expensive and the due diligence process is definitely higher. Valuations definitely remain high, especially for quality agencies. So even with the economic uncertainty, the multiples actually remain strong, especially for mid-size agency or small agencies that were well run, had great data, were able to actually generate solid information that the buyer can count on. There's more demand than supply, as we said, and agencies with a strong EBITDA, which is your operating profit, strong retention rate, a niche focus, clean books, and continuity in your staff. So waiting to drop the keys and leave is not going to command the same price as someone who was willing to stay, transition those relationships, have the staff that's supporting you go with the new buyer. Therefore, that retention rate will be stronger than one that might lose key people. All of those are still commanding some premium offers, but any of these things that are not existent, that offer will be far less than what agencies that have this makeup are. So again, it's their quality agencies. The valuation has not changed. If anything, it's actually gotten stronger, and maybe a plateau or a decline for those agencies that are not operating optimally. There's definitely fewer buyers because interest rates rose. Even PE-backed buyers, some didn't recapitalize, some slowed on how many number of deals they're doing. The top 10 buyers in 2024 made up over 40% of all of those deals. Broad Street, Hub, and InZone were among the most active. If you look at any of these reports that are out there, and it's reported by Marshberry, by Reagan, by the Hales report. There's lots of different information sources out there that'll tell you who those buyers are. But if you look over time, it depends on where those buyers are and their recap structure, how much funds they have, and how active they are in the marketplace. The other thing I would tell you is, if you're not well versed in the M&A space, not all buyers are equal. Not all buyers are actually looking for the same thing. So just because you know someone who sold to a buyer does not mean that that buyer is right for you. And many buyers are looking for different things. Some are interested in those that are close to retirement age. Some are looking for young owners that want to grow with them for a period of time. Some are interested in tuck-ins. There's a wide variety. There's as large of a variety in buyers as there is in sellers. So doing your research and understanding who those buyers are is incredibly important. And to do that early, so you have way more ability to be thoughtful in that process. Remember, these are only announced deals that we're talking about. There's plenty of buyers that are agency to agency that are cultural. Fit is incredibly important, even in these external, big buyer. Cultural fit is one of the most hardest to assess and the most important factor in this transition. And it's crazy important to understand who these buyers are and what would fit with you and what your customers will feel, what your staff will feel as they're going through this transaction. So Can't say that enough, but not all buyers are created equal, just like not all sellers are created equal and not all agencies are created equal. Organic growth is slowing slightly, but it's still strong. So agencies on the whole averaged about an 8.7 organic growth rate in 2024. That's a dip from 2023's 9.8%. So when you think about what drives the value of an agency, number one, growth. Number two, is it profitable? Number three, is it predictable and transferable? Is there anything that's going to cause my expectation of this performance of this agency to decline after a transition? And that could be concentration in one account, concentration by producer, concentration with a carrier, concentration in a niche that's volatile, lots of different things that can cause the predictability of the performance of the agency to change. Incredibly important to think about that. So growth overall for our industry has dropped slightly. Remember this is organic growth, not growth by acquisition. Inflation and market rate increases helped lift the premium volume, but growth is now more dependent on operational performance and retention than it ever has been. If someone's growth is just based on rate and the number of their policies or number of their customers is declining, when the market softens a bit, they're going to be the ones that see the biggest change in their performance, and therefore the value of their agency is going to suffer if they've not been able to hold on to their book and they're falsely thinking that their agency's performance is going well because they're not tracking their retention by customer and policies. So super important to have growth both in revenue and policy and customer on your mind in this environment. Agencies that are not growing organically can see reduced interest or lower valuations in the future. I actually think that's one of the greatest risks here because it could be masking the true performance of an agency. Okay, number 5, private equity definitely still loves insurance. And once private equity doesn't, remember, private equity drove our multiples up. If they leave, all of a sudden it'll change the volume of the deals and also the intensity of the deals and the demand. So, there are way more than just 35 PE-backed brokers, but they're the ones that are most active in the industry right now. They have billions of capital. They are definitely active. It used to be that PE-backed deals were only for large agencies. There's a lot of tuck-ins that are existing because the middle of our industry has had a lot of M&A activity. So tuck-ins can still command a nice structure. And again, if you're a buyer, if you're someone looking to acquire another agency, depending on the size of the agency, you could be competing with a buyer due to a tuck-in. I will say that 83% of independent insurance agencies are under 1.25 million in revenue, and half of that 83% is 500,000 in revenue or less. So there's a lot of small agencies that could be thinking, is this now my high? Should I be thinking that leaves a lot of opportunity for growth by acquisition for those that are looking to acquire? Many PE owners are nearing the end of their investment, so there's a recap structure that's going to happen, which could change that M&A churn and opportunity and drive even more M&A activity because they have to feed the next iteration of their structure. So just keep that in mind, that there's a lot of activity in the marketplace and it's stronger than ever. It's just not equal. And there's a divide between the agencies that are really interested in profitability and growth and those that maybe have flattened or are a lifestyle agency. So I'm going to pause here for our last poll question. And I'll give you guys some time to answer that question. Don't want to flip my screen until you can see it. So I will wait for your poll. Awesome. All right. So number 6, what is happening in the M&A space? Number 6 is banks are leaving the space. I don't know. Many of you might have been in the industry and you remember when we all thought, oh goodness, banks are buying up all the agencies. Well, actually in 2024, the numbers were bank-owned agencies just made 10 acquisitions of these announced deals. I can't speak to the ones that are not announced. And just for reference, some people estimate that the announced deals make up somewhere between 20 and 35% of the total transactions that occur in any given year. No one knows the answer to that, because if a bank loan's not involved and it's just an owner finance, there's no way to know the quantity of those that are occurring. But again, of the announced deals, there were only 10 acquisitions made by bank-owned agencies, and they also reported that they divested in 10 firms as well. So the activity around bank-owned is different than what it had been historically. At one point, that was actually one of the dominating, and that was one of the concerns in our industry. So if your agency was considering selling to a bank, that buyer pool is shrinking. That certainly the activity around that. I will also say there's plenty of other buyers that would be interested. It's just interesting to see that dynamic happening. And lastly, overall, what is the outlook of the M&A space? So we run a podcast and we had 2 of the biggest bankers who look at deals over and over and over again. And every single one of us, I had a lawyer on that focuses in M&A. I had 2 bankers, myself, that basically said, hey, if we had our crystal ball, what do we think is going to happen in the M&A space? And every single one of us says we think it's going to still be a seller's market. We think the outlook is strong, because we don't see that anything has changed that retention rate. If anything, it's still strong in this hard market. For some agencies, we can't say that, but on the whole, people need what we sell. People don't want to change because it's complex. We believe coverage will get more complex as the environment and our society continues to change. Despite slower Q1 numbers, the macroeconomic uncertainty, buyers are not going away. It's still easier to grow by acquisition than it is to grow organically. And there are a lot of people that have capital that want to grow by acquisition. Deal activity in 2025 is expected to match or exceed 2024. The second quarter numbers should be coming out really quick. We'll see if that's true, but that's definitely what everybody thinks. And agencies that can position themselves that are operational sound, growth oriented, and specialized will remain highly, highly attractive. Some of the things that make you unattractive is all of your staff is going to retire at the same time, or a large majority of your staff is going to retire, that there's not generational health inside your agency. I'll give you an example. I had an agency in Texas, 4 million in revenue, super strong, looked like a fantastic on the surface, would have had, PE buyers excited, would have had other buyers excited, until you dug in and saw that 71% of their agency workforce was at, beyond, or nearing retirement age, which meant in the next 2 years, they could have 71% of their staff exit. It seemed like an almost unsurmountable challenge to be able to backfill those roles in that agency, and the potential hit on retention because of the customer relationships, carrier relationships, staff relationships, and the resistance to change that aging staff force was really something that caused the value of that agency to change. So their growth wasn't bad, their profitability wasn't bad. It was honestly the expectation of the ongoing performance. So I guess my advice to anyone who's looking to grow by acquisition is go deeper. Make sure you do your due diligence. Make sure someone's helping you, represent you, to look at all of these factors that might look fantastic on the surface, but be a real risk factor inside an agency that you might not be able to see if you don't dig deep enough. one of the things that scares me the most is there are buyers that will go based on what they know someone else has done. This marketplace has changed. One of the other things that have changed is the thought process of I can acquire an agency and also acquire their carrier appointments has also changed. In this market, there's not a lot of carriers that are handing out new contracts to people who are not already established with the agency. Even if that agency that's buying is accessing that carrier through a network agreement, that might not be an automatic that you would get a direct appointment or maintain that appointment through an acquisition. So there's a lot of things that the way it's always been done is not necessarily the way it's being done today or will be done in the future. So definitely don't count on what you've heard someone else has done or what you think you've done in the past. The marketplace is changing, the players are changing, the environment is changing. While we believe that it's super strong, it is different, and you need to make sure that you have representation and advice to make solid financial decisions in this marketplace. The other thing I would tell you is if you think that you're going to near either transitioning internally or exiting, have giving yourself a 5-year runway to prepare for that type of decision is incredibly important and will put you in a position to have many different options. Someone who waits and says, I want to transition in 6 months or maybe even a year, there's not a lot of time to maximize the value of your agency from when you make that decision and when you're going to make that decision. So if you know that it's coming, getting a valuation, getting your financials in order, getting your data as clean as it can be, making sure you de-risk as much as possible by introducing your staff into accounts that might only have experience with the owner or exiting person or exiting, retiring people are really, really important. Thinking about those network contracts and what they mean to the succession of the agency are really important things that by looking at it differently and giving yourself the gift of time, you can give yourself the gift of many different options and maybe minimizing some of that risk. You do never eliminate all the risk inside any business, but once you know what those risk factors are, you can do something about them. So I'm going to pause there and give us some time for maybe some questions about the information that was shared here. I would love to answer anything that you've got on your mind. If there's any data in here that you want to talk about, I'm happy to do that. If there are no questions, I'm going to kick it back over to you, Jen.